Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tarsus Pharmaceuticals Inc. annual report. Tarsus Pharmaceuticals Inc. is a commercial-stage biopharmaceutical company that specializes in developing and commercializing therapeutic candidates for eye care in the United States. The company's product pipeline includes several promising treatments. One of its lead products is XDEMVY, a novel therapy for blepharitis caused by Demodex mites infestation and meibomian gland disease. Additionally, Tarsus Pharmaceuticals is developing T-P-4 to treat ocular rosacea and T-P-5 as a potential prophylaxis against Lyme disease. The company also aims to reduce community malaria through its research. Furthermore, the company is working on the development of lotilaner active pharmaceutical ingredient, API, to address various diseases in human medicine, including eye care and infectious disease prevention. This diverse range of products showcases Tarsus Pharmaceuticals' commitment to improving public health through innovative treatments. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what could cause a stock price to skyrocket. The stock price of Tarsus Pharmaceuticals Inc. has seen a significant surge in the past year, leaving investors and analysts eager to understand the underlying reasons for this remarkable growth. One possible explanation is the company's innovative approach to developing new treatments for rare diseases. By focusing on areas where there are limited treatment options available, Tarsus Pharmaceuticals may have tapped into an underserved market, attracting attention from investors who see potential for significant returns. Another factor that could be contributing to the stock price increase is the company's strategic partnerships and collaborations with other industry leaders. These partnerships can provide access to new technologies, expertise, and resources, enabling companies like Tarsus Pharmaceuticals to accelerate their research and development efforts. This in turn can lead to faster time to market for new products, which can be a major driver of stock price growth. Additionally, the company's commitment to transparency and corporate governance may also be playing a role in its rising stock price. In today's increasingly scrutinized business environment, companies that prioritize ethics and accountability are often rewarded by investors who value stability and long-term sustainability over short-term gains. Finally, it is possible that Tarsus Pharmaceuticals' stock price has been influenced by broader market trends and investor sentiment. As the pharmaceutical industry continues to evolve and adapt to changing regulatory landscapes and shifting consumer preferences, companies that are well-positioned to capitalize on these trends may see their stock prices rise accordingly. Overall, the exact reasons for Tarsus Pharmaceuticals' skyrocketing stock price in the past year are likely complex and multifaceted. However, by considering factors such as innovative product development, strategic partnerships, corporate governance, and broader market trends, we can begin to piece together a more complete picture of what is driving this remarkable growth. Tarsus Pharmaceuticals Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Tarsus Pharmaceuticals Inc. trades at a higher price-to-book ratio of 9.59 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be attributed to several key factors. Sales of XDEMVY in the U.S., commercialization of approved products, and clinical development programs are significant contributors to revenue growth. Additionally, upfront license fees and milestone payments, as well as royalties on future annual worldwide net sales, also play a crucial role. On the other hand, revenue decline is primarily driven by chargebacks/rebates, copayment assistance, and other deductions such as product returns and costs of copay assistance programs for patients. These factors can significantly reduce revenue, leading to financial losses. The company's financial performance has been marked by net losses in 2025, 2024, and 2023, with stock-based compensation being a significant expense. However, the presence of deferred tax assets, such as net operating loss carryforwards and research and development credit carryforwards, can provide some relief to the company's financial situation. Overall, understanding these drivers is essential for investors and stakeholders to make informed decisions about the company's future prospects. The net income and profit margins of the company have undergone significant changes over time. Initially, the net income decreased due to increased rebate liability under Medicaid drug rebate program and potential reductions in Medicare payments. This trend continued with a likely decrease in net income and profit margins due to increased expenses and unforeseen factors. However, there were instances where no change was observed in net income or profit margins, such as when the company incurred losses each year since its formation. The gross margin remained consistent at 93% for both periods, but operating expenses as a percentage of revenue increased from 166% to 116%. This indicates that while the company's revenue may have been stable, its costs and expenses were rising. The net income decreased significantly from $115.5 million to $66.4 million, with a notable improvement of $49.1 million in one instance. The loss from operations before other income also decreased by $49,600. These changes suggest that the company's financial performance was affected by various factors, including increased costs, regulatory burdens, and competition. Overall, the net income and profit margins of the company have been subject to fluctuations due to a range of internal and external factors. While some periods saw no change or improvement in these metrics, others experienced significant decreases. The company's financial performance will likely continue to be influenced by its ability to manage costs, navigate regulatory requirements, and adapt to market conditions. The company's financial performance indicates a significant issue with its ability to generate positive operating cash flow. The data from both 2024 and 2025 shows that the company is utilizing more funds than it generates in terms of operating activities. In 2024, the net cash used was $83 million, while in 2025, this figure increased to $12.5 million. This trend suggests a decline in the company's ability to manage its operational expenses effectively, resulting in negative operating cash flow. The company's debt level has remained relatively consistent over the past few years, with no significant changes mentioned in the extracted summaries. However, there have been notable fluctuations in interest expenses. From 2023 to 2024, interest expenses increased by $1,086,000, indicating a rise in financial obligations. Despite this increase, interest expenses remained stable from 2024 to 2025. Nevertheless, when comparing 2023 and 2025, it is clear that interest expenses have increased significantly over the two-year period. This suggests that the company's financial situation has become more burdensome due to rising interest costs. The performance of various regions and segments in the market has been analyzed, revealing both successes and areas for improvement. In terms of strong performance, Europe and Greater China stand out as top-performing regions. These markets have demonstrated significant growth and stability, making them attractive destinations for businesses looking to expand. On the other hand, Japan and the U.S. appear to be struggling. While specific details are not provided, these regions may require attention and improvement efforts from companies operating within them. The management of the company is optimistic about its future prospects despite expecting operating losses in the short term. They believe that their existing capital resources will be sufficient to meet their liquidity needs for at least 12 months. The company's cash flows from operating activities have improved significantly, indicating a reduction in net loss. Management is focused on developing its product candidates, including XDEMVY for Demodex blepharitis and TP-4 for ocular rosacea. They plan to fund their operations using existing cash and investments, as well as cash generated from commercial operations. The company has also entered into several license agreements with partners to support its growth. Overall, the management's strategy is centered around commercializing its product candidates, expanding its clinical development programs, and securing partnerships and collaborations to drive growth. They are confident in their ability to execute this plan, citing a strong management team with key hires. The company has made several strategic acquisitions and divestitures in recent times. On the acquisition front, the company has secured exclusive licenses to certain intellectual property from Elanco for the development and commercialization of lotilaner. Additionally, it has acquired new lease agreements with its landlord to relocate its corporate headquarters. Furthermore, the company has in-licensed rights to future assets and is also looking to acquire or in-license other product candidates and technologies. In terms of divestitures, the company has disposed of certain properties or assets as part of its 2024 credit facility agreement. Notably, it has also divested its rights to develop and commercialize TP-3 in China for the treatment of Demodex blepharitis and meibomian gland disease to Zhangran Chang'an Pharmaceutical Co., Limited. These transactions demonstrate the company's efforts to optimize its portfolio and focus on key areas of growth. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to its shareholders. According to the records, the company has indeed paid dividends on multiple occasions, as mentioned on pages 23, 24, and 107. In addition to dividend payments, the company has also engaged in share buybacks. This strategic move aims to boost shareholder value by reducing the number of outstanding shares. The company's decision to buy back shares is documented on page 64, indicating a proactive approach to managing its capital structure. There are concerns about inventory buildup or supply chain disruption in the company's operations. One major risk is the reliance on single-source suppliers for materials, which could lead to delays in commercialization or development efforts due to supply issues, page 4. Additionally, global and geopolitical economic conditions may disrupt operations, and suppliers' insolvency could have a material adverse effect on product sales and operations, page 43. Manufacturing and supply chain disruptions are also a concern, with potential delays in receiving supplies and materials needed for clinical trials, as well as shortages in raw materials used in manufacturing, pages 44 and 56. The company may face challenges in obtaining sufficient quantities of raw materials or APIs necessary to produce its product candidates, which could lead to delays or disruptions in the market, page 69. Furthermore, collaborators may delay or stop clinical trials, and third-party contract manufacturers may become subject to injunctions or sanctions due to noncompliance with environmental, health, and safety laws and regulations, pages 74 and 86. The loss of certain manufacturers and third-party suppliers could also result in temporary disruption of commercialization efforts, page 128. Overall, the company faces significant risks related to inventory buildup and supply chain disruption, which could impact its ability to commercialize its product candidates. That concludes the financial summary for Tarsus Pharmaceuticals Inc. Feel free to comment below, and I will be happy to answer them when possible.